First question I just have to ask is how you ended up in Denmark, because looking at your name and your background, I don't think it was written in the stars that you would end up in Copenhagen. What's the storyline and how did you end up in Saxo in Denmark?
Well, the reason why I ended up in Denmark is because of love. My husband is not a Danish, actually he's Norwegian. But while we were both working in finance in London, he was offered a job by one of his clients. It was a Brexit time and we were about to get married, and we thought Denmark would have been a better fit for our family than the UK. And we really like it here, Christopher. I think that Copenhagen is an amazing city and definitely good life and work balance. But my story in finance started much longer ago. I studied finance as a bachelor in the US, Northeastern University. I did an internship while I was there in New York with Goldman Sachs. And then I moved on to London, where I earned my master's degree at the London School of Economics. And after that, I was looking to enter in finance, but I didn't have idea of where to go to, also because at that time, 2010, there was a lot of topics overlapping. We were just fresh of the global financial crisis. And there was a lot of investment in compliance and these kind of sectors. I was never really exposed into banking except for that internship in the back office of Goldman Sachs. So I really knew that I didn't want to be in the back office. I wanted to do something more proactive. And that's why then I explored career opportunities in sales. And then I was approached by Bloomberg. At that time, I thought that Bloomberg was a great opportunity for me to understand the buy side and the sell side and the various figures that are in finance that I didn't touch upon while I was in the US. And that's why I embarked in a career in sales there in Bloomberg, selling the terminal. And after 3 years, I decided that it was time for me to be in a sales role in finance. I wanted to deal with financial products.
It seems like you have had experiences from Italy, UK, even Mexico. How important, or in hindsight, how good is it to have been around different countries, different market environments, to then today see it as a global strategist trying to understand how every pieces sort of fits together in one way or the other?
I think that each experience that I had was enriching in its own way. You touched upon Mexico, for example. There I was doing an internship for the United Nations. And what I was doing was helping an economist with a research on small and medium enterprises and why they cannot access finance. So it was all still quite narrow focused and technical. But, also now when I look at markets, I look Latin America or other emerging markets, I understand why there are some challenges I had. And as an investor, my point of view, it's different from what it was there. But I definitely consider what I learned in those instances when I invest in this kind of bonds.
Makes sense. So a bit of a fun question, but I think you're okay with it. So in Scotland, you can, get the Lord title if you buy it, for instance, and you have a Bond Girl title. So what do you have to do in order to attain that title? Do you have to go through hurdles, or can you just say that you are?
Well, I'm called Bond Girl because of a linguistic mistake. So it was my second or third day in Saxo Bank, and there was our CEO and founder, Kim Fornays, on the floor. I was very eager to meet him, and I go to him and say, "Hi, I'm Althea, the new Bond Girl." And everybody heard it and started to laugh. So that's how I earned the Bond Girl title. I said it without actually referring to the Bond movies. But if we think about bond and girl. I'm a girl and I work in the bond market. So I'm very proud of the title.
Yeah, it's a great title. Maybe if we dive into the bond market, so just to keep it super simple, so just to explain it by first principle, what do you say to people who are just starting out trying to understand the bond market, just to define what it is and how it works?
Yeah, I would start off saying the bond market is the biggest market of them all, much bigger than the equity market. So when you think about the equity market, if it's easy for you to buy and sell a stock, here in Saxo Bank, we are trying to make it as easy to buy and sell a bond. And normally, when we talk about very good quality and sovereign bonds, that's fairly easy to buy and sell. Then when looking at a bond, the way we talk a lot about yields, literally what yields means is that if you buy a bond today with a certain maturity at a certain yield, you're locking in that yield until maturity. So you give, you basically pay the price to buy this bond. You get a coupon while you hold this bond, and at maturity you're getting the principal, that money that you paid before back. That's very different from the stock market, because you can say like, oh, dividends, earnings, and so forth, but nothing is guaranteed in the stock market. Bond market, it's a safer investment. It guarantees a return, and it's very much in vogue again because yields are the highest that we have seen since 2007. So literally, if we look at the macroeconomic environment right now, where the stock market is overvalued and a bond gives you a decent 5%, and with a bond, I'm talking about the safest asset out there, US Treasuries, then clearly the incentive to buy stocks should decelerate in the foreseeable future, because you can lock in 5%, but if there is a repricing in the stock market, you might have to lose much more money.
Definitely. If you're looking at the biggest misunderstanding, maybe the first one that comes to mind, if you're quite new, is the relation between the interest rates and the bond price. After that, what do you think? Are there any big misunderstandings when people are looking at the bond market?
I think that now, when people are looking at the bond market, are really much looking at duration. So everybody now is hyped about this Austria Centurion bond that is trading at $35 cents on the dollars. So basically, it's very important for people then to understand that the way that they're thinking about that is very similar to how they think about the stock market. They want to buy that bond because they think that if central banks can't interest rates, that valuation is going to go much higher, and therefore they're going to make 40%. So basically, they are comparing it to a stock. But the bond market right now is offering much better opportunities. So, Chris, if you have capital invested at 10% for 10 years, you are doubling your investment. And right now, if there is bonds out there that they can offer 7-8% for 10, 15 years. And they pay not only, like they are not in distress value. So basically I'm talking, well below 80, right? Like, for example, the Austrian Centurion bond. They are more expensive, but they pay a regular coupon. And basically, what's the difference between one and the other? If you buy today the Austria Centurion bonds, and there is still uncertainty on how the central banks are going to behave with the current macroeconomic backdrop, and if these rate cuts don't arrive, then you will be a bag holder because you're going to lose money and you don't see scope to sell that bond. But if instead you buy a bond with, I cannot say, like the same maturity because it's 100 years and there is very little bonds out there. But let's say you buy a bond with 10, 15, 20 years maturities that they pay a coupon of 7 and 8% yearly. And then at that point, even if you can collect that coupon, you can invest money elsewhere. And at the same time, if central banks are going to begin to cut interest rates, even that instrument will gain, not only the Centurion bond, obviously at a much slower pace, right? Because the modified duration in a Centurion bond is much larger than in a bond with a greater coupon. But still, they will be gaining in price, and you can still sell it at a premium while collecting these coupons. So these are all things that need to be considered when buying bonds. And I think the duration topic is very hot right now. I'm on Twitter. Everybody talks about the duration. Everybody wants the Austrian Centurion bond. And I don't believe that at this point in time, a lot of people make the comparison with a bond with a different kind of profile, like the one I said and described.
It's a great example. I think you had one video out on Saxo where you broke down why to invest in bonds and what to consider. And I think you said that one of the risk factors is the inflation risk and the interest rate risk. Can you just explain that with simplicity for people? So, because today it seems like the narrative is that, of course, you should buy bonds now if you compare it to 10 years ago and all the macro things going on. So, but still, there's no free lunch, right? So is those two the typical risks that people just need to understand before buying bonds?
So when we talk about inflation risk and interest rate risk, we talk about monetary policies from central banks and obviously inflation risk. What we talked about in the past year is inflation risk. When you look at sovereign bonds, normally you look at nominal yields, right? If inflation is high, that nominal yield will be eroded by inflation. And central bank, as a consequence, because their first mandate is to keep inflation under control, will also need to hike rates, exactly like we have seen in the past year and a half. So why this is important? Whoever bought US treasuries or European sovereign bonds last year has seen the total return of their assets falling massively, right? But when you look, for example, at corporate bonds, right, they have another component to it, which is the corporate spread. So what I'm trying to get at is that not even if you have rising interest rates, if you buy an instrument such as corporate bonds or inflation linkers, that they behave somewhat differently. They are not as reactive to central bank monetary policies or inflation. People might still be able to build a buffer against monetary policies. So right now we have real interest rates in the US above 2%, I think 10 years, 2.5%, and the very front part of the yield curve around 3%. Right now, that kind of real yield, it's really enticing because we are having still inflation in the US around 3.7%, is far above the central bank target. So it means that central banks are going to stay on hold or hawkish for a longer time because they need that number to go below 3, right? But there is a risk, and this comes from a lot of factors: geopolitical risk, weather, and so forth. That commodities start to pick up again. So inflation starts to pick up again in the last part of this year. And the problem with that is that if you hold a nominal bond, right, and I'm thinking about US treasuries at 5%, if the central banks continue to hike rates because inflation is on the rise, then you are going to be still suffering from this monetary policy decision. But if you buy real rates, right, then yes, you will still be losing money in total return, right, kind of view, because if interest rates are hiked, the yield on the real yields will continue to rise. But you have an inflation component that if inflation rises, then the payment that you get from that bond and the principal you would get at maturity will be higher. So basically it creates a bigger buffer against whatever happens, monetary policies or inflation. And a little bit is the same with corporate bonds. Why people look at corporate bonds if they are riskier than US sovereigns? The reason why they do that is because corporate bonds offer a pickup over US treasuries. So they offer a buffer against which, if there is some uncertainty or volatility, that buffer can work in preserving the valuation of their portfolio.
Just hearing at that answer, now you understand how complex this world is, because if you're not into it, it's very hard to maybe truly understand everything. But if you were to, do a case study to see, the effects of interest rate, bonds, etc., is the most natural thing just to go to the US and truly understand what happens in US treasuries and trickle it all the way down to companies, investors, etc.?
Definitely, because everybody feels the pressure from US rates, right? Not only US corporates, but also European sovereigns. Like the reason why we have seen European sovereigns selling off in the past couple of weeks has been because we had higher US treasury yields. So there is a lot of correlation in that sense. But now we are arrived to a juncture that it's a very difficult environment for investors to make a decision, because we have inflation that, as we said before, remains elevated, almost 4%. We have the economy that is decelerating, obviously. We have a conflict on the making in the Middle East. And investors are expecting that the Federal Reserve will not do anything anymore. But we cannot really exclude that, because in the past 18 months, the Federal Reserve has been doing what the market was not expecting to be done. Like if we take, maybe now I'm going a little bit more technical, but if we look at the SOFR futures, the SOFR futures basically indicate what's the expectations in the future for Federal Reserve interest rates. So on the back of the SVB crisis in March, the 3-month SOFR futures for December 2024 was showing expectation of the Fed fund rate to be at 2.7%. Now we are at 5.5%, huge cuts in 2024. But that went from 2.7% up until 4% recently. So basically what this is telling us that our market expectations build in daily, and things can change, but whatever the market is pricing might be wrong. And the market was wrong clearly in March, because right now we are in a completely different situation. And the market might be wrong also today, right? the market now is pricing not only for rates to drop to 4% in 2024, but is pricing rates to remain around 4% for the next 10 years throughout all the curve. And then, actually to rise slightly, I think like in 2028, 2029. That might be still wrong. So as an investor, it's very important to understand where are markets' contradictions and try to trade with them.
Interesting. I'm just thinking when you're explaining this that, so many people always try to predict the future and looking at the data they have today to make an analysis on what will happen, in 5 months and 10 months, etc. Giving all the data you have in your head and all the things you have seen, how hard is that exercise to predict with certainty what will happen, even in bonds and and in instruments you would think is a bit more stable than maybe a volatile stock?
I think it's impossible, Chris. The problem is that it's very easy in finance, like in life, to jump into conclusions. For example, this week the war between Israel and Hamas started. And there has been a lot of people that jump to the conclusion, the Federal Reserve is done, is going to cut rates, or, like the US is going to enter in a conflict. But realistically, as a strategist, you have to pick all these views with a pinch of salt. To me, a war between Israel and Hamas just means that we are heading towards a period of high volatility and high uncertainty. And how do I position for that? If I want to hedge my position and I want to lock in the best risk and reward ratio, for me is trying to keep quality and to limit duration risk. And the only way to do that is trying to get, like very well-rated investment grade corporates, US treasuries, the safe haven, but remaining in the front part of the yield curve. Because it is true that if the Federal Reserve engages in interest rate cut environment, the long part of the yield curve, so I'm talking like ultra long, 20-year plus, is going to drop. But we don't have the certainty that that's going to be the Fed's next step. And with the US inflation at 3.7%, and interest rates at 5.5%, the market still working as a whole, the economy still recording, expected to end the year in positive growth. I don't see why the Federal Reserve will need to cut rates. And if it does, then at that point, you can take on more risk. But so far, uncertainty, volatility, my first impulse is the one to limit risk.
Yeah, that's a great answer. Looking at who should invest in bonds, I think that is also an interesting question, because for me, it seems like there is some inflection points, either in terms of years. So if you're 50 or 60, fixed income seems a better idea than if you're 20 and just want to have exposure to stock market and index funds. Or if you have a huge fortune, maybe it's hard to psychologically, have a market crash and see that you're losing 50% of your fortune. So just to try to break it down to who should really invest in bonds, because if you're young and not very rich, should you then invest in bonds, or is that just a bad strategy if you're thinking compounding for the long term?
Bonds are never a bad idea. Bonds offer great diversification. So even those investors that have a very massive equity position, they would like still to look at safe havens like US treasuries, the Bund, in order to diversify for a downturn in the stock market. And, I'm active in Twitter, and what I see right now, it's a lot of people saying, now I'm shorting stocks. They are literally thinking that something is about to come. And when people are massively short in stock, that movement is going to follow somehow, right? It's true that in history, the correlation between stock and bonds have been negative. And that of lately, we have seen yields rising, which is bearish for bonds, and also stocks dropping. But at a certain point, that correlation is going to be restored. And the best example has been this week with the Israel-Hamas war. Where did the investor go? Well, they went into the safe haven, the 10-year US treasuries. And, we have seen yields dropping massively. But it's also important to notice that the drop in yield that we have seen is not being caused only by a safe haven demand. No, that has been caused because last week a lot of investors had massive short positions on long-term bonds. So if you have some haven demand this week because of the war, then of course bonds are going to touch upon some certain levels that is going to take them yields lower, right? So what we are seeing is a technical correction in yields. The problem is what is going to follow. The war is war. We are going to have some headlines, but we still have inflation, and there is still a lot of selling pressure. We have quantitative tightening. We have larger coupon US Treasury bond issuance. We have repatriation of foreign investors, and all these things are real, and they continue to happen despite the war. Yesterday, we had a 3-year US Treasury auction. There was the lowest foreign demand since October 2022. This indicates that all these forces continue to add up, and as soon as we take off that lead of the war, yields might resume to rise. So, and this comes back to what we were saying before, if the central bank, the Federal Reserve, is positioned to keep rates at these levels, maybe it's not convenient to take on duration risk.
Yeah, okay. So if I buy the premise that even though if you're a young professional, you need to have bond in your portfolio, how do you break it down to the next level? Are there any principles, risk profiles? Because like in the stock markets, it seems like the bond market has become quite sophisticated with products, ETFs, etc. So how do you navigate that whole market? Because that's also something that can be difficult for an investor to truly understand.
So there is there is a big difference between ETF and cash bonds. So when you buy a cash bond, like we said before, you lock in a yield until maturity. It means that if you lock in a yield 5% and you wait 2 years, you're going to get back that cash, right? ETFs don't work the same way. ETFs have underlying a lot of instruments. So what is good about them is that you get a lot of diversification. In some instances, they give you access to markets that otherwise you would not be able to access. Like, for example, high-yield corporate ETFs. Normally, the minimum size to buy one high-yield bonds is around $50,000 to $100,000. So, if you are a small investor, even if you have $100,000, why would you put all your risk, all your money into a high-yield bond, right? But instead with ETFs, you can diversify. You can buy one ETF tracking high-yield corporates, and within that ETF, there is going to be hundreds, thousands of different names. So even if one defaults, that's not going to affect massively your investment. And that's all good. The problem with ETFs is because they don't have a maturity. Let's assume one is looking to buy the short-term US Treasury ETF, right? I think that the ticker for that one is SHY, SHY, and it tracks US Treasuries with maturity from 1 to 3 years, right? So what does that mean is that the portfolio manager of that ETF will constantly buy and sell US Treasuries in order to keep the maturity, the duration of that ETF in check, because you don't want to be too short. There is another ETF with a maturity of less than 1 year, and you don't want either to be long. The problem with that is that you cannot really manage interest rate risk, because if interest rates rise, you cannot just keep your investment there and get back cash and maturity. The total return of all the ETF is going to be affected, and once that you sell it, you're going to pay for interest rate risk. But being said that, what is good to know, and that goes back to our earlier conversation, is that we might have reached some sort of peak in interest rate. Okay, there is still the risk that the Federal Reserve might hike again. Okay, how many times? Once, twice? We definitely are not going to see the Federal Reserve, hopefully, because otherwise it's going to be a complete blowout. But we are definitely not going to see the Federal Reserve hiking interest rates by 500 basis points, right? So what I'm trying to say is that as interest rate peaks, the ETFs become a better instrument to diversify, to take exposure to specific parts of the market. And in some cases, like, for example, investment grade, corporate ETFs can create also a buffer, because there is that credit spread component that we were talking about that might provide a buffer against rise in interest rates.
Yeah, that's a great way of breaking it down. So in the stock market world, let's say, you have so many inspirations, different investors who write books, etc. In the fixed income world, do you also look at investors or funds or companies who are producing alpha relative to all the other peers, or is it more a bit less unknown world, if you get what I'm saying? Do you have like an environment or companies who are spectacular in their way of investing in fixed income?
Oh, absolutely. You have normally the biggest players in the fixed income environment are hedge funds, right? But the thing is that bonds are an instrument that are used widely. So hedge funds look at them speculatively, in a speculative way. But bonds, US Treasuries, sovereigns, they're normally traded and invested by treasury departments of companies, of banks, central banks, right? In a certain way, also the ECB is invested in the bond market. So there is always the lookout, and the different kind of views that you get from each of these players is going to be different, because probably a bank, I'm not talking about a central bank like the ECB, but a proper, private bank, is going to look at sovereigns and their bond investment from a different perspective than a hedge funds, clearly. And their way to create alpha is going to be much more aggressive from a hedge fund, like in a hedge funds than in a private bank.
Maybe also, I know that we touched upon it already, but just to specify it, if you look at bond investors or funds, those who are building a fund on the high yield market, maybe in a specific location, that usually comes with more risk, right? Because if you lend money to a company who is in need of money, and maybe the environment like we're going through now, higher interest rates, maybe a recession, then it will of course come with a lot of risk. And then you can maybe in a couple of years look back and say, who gave the loans out to the companies who survived and managed to get the cash back? Because I don't know, if you hit a recession, a lot of companies will have to default at some point, I guess.
Yeah, but that's up to the investor to decide. There is a lot of greed out there, Chris. And of course, if you're greedy, why would you invest in the US investment grade market that is paying 6% when you can invest in the high yield corporate bond market that is paying you 9% in yield? You know, definitely you want to receive 6% or 9% yearly. I definitely want to receive 9%, but the problem is that to get that 300 basis points pickup, you have really to trust that the household card is not going to fall.
And it's also, if you look at that, it's just a horror story always, the US crash with the junk bonds, etc. Or do you think you will see that again in the future in a different structure, etc.?
It's very hard to see what is coming, but we can definitely talk about what we have seen in the past year. And what we have seen, we've seen a banking crisis somehow in the UK during the mini budget crisis in September, because with rising interest rates, a lot of derivative positions triggered margin calls, and a lot of pension funds didn't have the money, the cash, to cover it up. We have seen the SVB crisis in March in the US. So it would be naive to think that nothing else is coming, right? And that's why I go back to what we were, to what I've been saying since the beginning of the call. Like, you want to be as conservative as you can. It's true that you might not outperform market. Look at those people that were expecting a crisis last year, and the stock market, the Nasdaq went basically like exploded. But it was unforeseeable. And it's very hard to make those decisions in a rational way. What is rational right now is to understand that we are in an unprecedented kind of interest rate environment. We didn't see this since 2007. In 2007, that was followed by a very deep crisis. If we look at other environments, when the Federal Reserve has hiked, not only Federal Reserve, but also the ECB, we've seen that everything has been followed by some sort of crisis, and definitely this is going to come again. But does that mean that then, because at a certain point in the future, central banks are going to cut rates, which they will? The problem is when, right? Does that mean that I have to go and buy my Austria Centurion bond? Probably not, because we have seen that right now the position of central banks is to put pressure on the economy, and until that is in a place, my appetite to increase duration risk is not strong, but it will become strong, and it will be I tell you, last week it was tempting to enter 10-year US Treasuries at 4.8%. There has been the 30-year US Treasuries at 5%. Amazing levels, not only for speculators, but also for buy and hold pension fund kind of investors that they want to secure, like solid yield, risk-free, for the next 30 years. It made absolute sense. The rally this week, a correction after the sell-off we have seen, it's absolutely understandable. My question is, can it last? Obviously, it's helped by what is happening in the Middle East. Yes, it could last, but like, I want to see that CPI print going lower. Even though there is a war in the Middle East, because war means higher inflation, but also means bigger spending, and bigger spending comes with more bond issuance. So both of them are bearish for bonds.
Your summary is spot on. And also, when you're talking about these returns you can lock in, there are sort of unprecedented looking 10 years back, so maybe people should realize what a good opportunity is when it comes around. Just some fun questions to end the conversation with, because one of my favorite reports comes from Saxo every year, and it's about outrageous predictions. I know you can't share what's going to be there, but can you tell a bit about the report, why it is important to think scenarios that may not happen, but like you said, you need to also expect unexpected at times. So can you just explain a bit how that report works and when it will be out?
It will be out, normally it's out in December, beginning of December, and we are currently working on it. No spoilers, because I cannot. But the reason why we produce it every year, and we are quite proud about it, is that we put forward some scenarios that investors will be outraged with. You know, they would never position for them to appear, but somehow in history showed that they might happen. Like, for example, Brexit. It was one of the team's outrageous predictions in 2016, I believe. That, or before 2015, obviously, because if Brexit was 2016. But it's just a brainstorming to understand. Not brainstorming, is just a different way to look at markets and to understand that the rug can be pulled out from our feet any time in the future. So one can feel strongly about their Austria Centurion bonds, and this week is going to be like a perfect investment to hold. But when that goes the other way, it can go fairly quickly. And it's not only, I'm so sorry, I think that I have been I've been bothering all the people holding this bond. It's not about the Austria Centurion bond, but it's about all investments. Like, for example, you know, bull flattening, bull steepening, bear, you know, like all this kind of positioning. You can, it's very easy as an investor to enter into the market and start to love that position. You know, like maybe the best way to describe it, or the best comparison, is to look at Tesla and think about all those people holding Tesla. They love their Tesla, right? And but realistically, there has been ups and downs even there. So, you know, don't get to love your investments. Don't love things that they don't give you back love. That's the main thing. It's important to look at them objectively and to understand that anything is possible and things can change from one day to the other, exactly as it happened this week with the war in the Middle East.